Hey, Brent here with First International Bank and Trust. Hope you're doing well. Today we want to talk about student loan payments and how that affects what you might qualify for on a mortgage and how we calculate those numbers. So if you are carrying student loan debts or making student loan payments, even if the payment's at zero, we do have to account for that. And there's different ways that that's looked at depending on the type of financing that you're qualified for or looking into. So four different types of mortgage loans typically. We're looking at conventional, FHA, VA, and then USDA. And I'll go through each of those real quickly here. So if you don't have student loans, this video is really not going to be for you. If you do have student loans, just take a listen and see how that might be affecting what you might qualify for. So we'll start with conventional loans, two different types of conventional outlets, Fannie Mae and Freddie Mac. You may have heard of those. With Fannie Mae, they are going to look at what you're making for a monthly payment. If it's on the credit report, if it's income-based repayment, that's fine. They just use what is listed on the credit report. If there is no payment listed, then they do go with a 1% monthly payment factor. So a $10,000 balance, plug in 1%, we would plug in $100 as your monthly payment on that. For Freddie Mac, very similar. The only difference is they use a 0.5% for your qualifying factors. So on a $10,000 balance, you would be looking at $50 a month on a Freddie Mac loan. So moving on to FHA financing, they're a little bit more strict. For years and years, they used to use just a standard 1% of whatever your balance was. It was a little bit harder to qualify for, and that's what got plugged in regardless of the situation of the loan. So in 2021 here, they actually updated that, and we'll be able to use a 0.5% factor. So on a $10,000 balance, instead of budgeting for $100 a month, it actually is $50 a month, which is a significant change for FHA. So for VA financing, they actually use a little bit different calculation. If the payment is deferred for 12 months or more, we actually can exclude that altogether from your budget or from your debt to income ratio. If you've got a payment that's deferred for 12 months or less, they're going to take 5% of your balance and then divide that by 12 months. So on a $10,000 balance, you'd be looking at about $41.67 roughly per month to plug in on that. So if it's going to be lower than that, then they just want to know why, and there's some additional steps to document that for VA. So last one is what's called USDA financing for the Rural Development Guarantee Program. And basically, if it's a fixed rate, fixed payments, you can use that amount. If it's not, then you're looking at the greater of a 0.5% factor or the current monthly payment. So you can see a lot of this comes down to whatever your balance is, taking it by a percentage, and then calculating that and plugging that into your payment. A lot of moving parts there. I understand that, a lot of information thrown at you. So if you'd like us to look at that for you, if you're concerned with some student loan things or being told different information and you'd like our team to look at that, I would be happy to do that for you. Feel free to reach out to us or give us a call, reach out to our page or give us a call anytime, and we'll be happy to talk you through that. So hope you're doing well. If you have any questions, reach out, and hopefully we'll talk to you soon. Thanks.